From New York City for our viewers worldwide, I am Lisa Abramowitz in for Jonathan Ferro. Right now, you are seeing a surge in markets at the heel of a softer than expected CPI print. We'll walk you through that. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open with Jonathan Ferro.
We begin with the big issue. Markets looking at one thing.
Today's CPI number.
Another CPI reading.
This was a good report.
The market is desperate for some kind of hard evidence that the inflation surge is lessening.
This is a necessary print for the Fed, but it's not sufficient. We need to see a lot more.
If we've reached peak inflation, what does that really tell us?
We're going to see inflation decline, but to what level?
Does it mean it's really going to fall down to that 2% target that the Fed is looking for?
This idea of peak inflation, that's just a math problem to us. I'm not sure it's investable.
We are entering, I think, a new phase in the inflation debate.
It's really about core inflation.
Ultimately, the Fed focuses on core more than headline.
With this jobs report and the inflation number,
it's not surprising that we're seeing a bit of a rally here.
What Chair Powell told us is, well, he's data dependent.
It makes more likely that our call will be right for the September FOMC hike of 50 basis points.
All talking about that CPI, and if you're just joining now, it came in at 8.5% versus the expected headline number of 8.7%, fueling this rally in markets ahead of the open. Joining us now, Richard Bernstein of RB Advisors and James Camp of Eagle Asset Management. Richard, love to start with you. Your first reaction on how much you can lean into this rally, lean into this feeling that this really does relieve pressure from the Fed.
So Lisa, good morning. I think that the Fed is still on full watch. I think that we have one number which is certainly encouraging. No two ways about that, right? It comes in better than people think. But we have service inflation still rising. Most people haven't pointed that out yet. Service inflation is still rising in the United States. The labor market is historically tight still. And the economy is historically unproductive. You haven't heard too much about that either. The last print, the U.S. was the least productive year on year it has ever been in history. So that is not a good combination for inflation. I think the Fed's really still on full watch.
And I would guess that a lot of people are feeling the same, in particular Academy's Peter Shear, who just weighed in on the latest CPI report, writing, fading this on the risk side of the equation. It's still high enough so the Fed is not completely out of the picture, which may lead us back to fixating on recession, inventory, semiconductors, warnings, et cetera. James, are you in the same camp as Pete Shear?
Yeah, Lisa, we've discussed what I call the inertial elements of the CPI and inflation, and those things are still intact to us. Owner's equivalent rent, wages, as Richard mentioned, lack of productivity growth. We had better oil prices. I mean, that's essentially what the CPI tells us. That can reverse. I mean, if China reopens and a number of other things happen, that can go the other way. So I think the Fed is absolutely committed. They have made a policy error a year or so ago, and I think this is still a go, perhaps for 75. But we're going to get the funds rate, the real funds rate, well above equilibrium, and we're going to slow aggregate demand. That's the only game left for inflation. We're not out of the woods. We've missed, by the way. This is the first time we came in better than expected on inflation. We've missed to the downside 17 of 18 months. So I think the inflation story is misunderstood by a lot of people.
Wow, 17 out of 18 times. It's incredible perspective. Just to sort of recap where we are after this better than expected or weaker than expected CPI front, you are seeing it reflected in Fed funds futures, inflation cooling more than expected. Now there are these bets for a more dovish Fed that continue to pervade the markets. The software print triggering a move in risk assets, futures surging as bond yields plunge. Michael McKee here. Mike, how significant was this decline in the CPI?
Well, it's significant because it was more than expected, and in a lot of areas the Fed has been expecting to see drops. We got those. So I don't want to go back to the word transitory, but some of the things that stayed up longer than they anticipated were falling. Now, gasoline prices were the biggest change in this CPI, down 7.7%. Food, though, still rising. Owner's equivalent rent, the measure of home prices, still rising at a significant pace. So those things are going to keep inflation elevated for a while. Used cars, apparel finally fell. Also, I didn't have it on this list, but airfares fell a lot. should keep falling because the major travel season is going to be coming to an end. So there's a possibility we see this again in the August report in September. But as Richard was pointing out, services prices are still rising, and you can see the blue there. Those are services prices as goods prices come down as people shift their spending. And the question is, are they going to continue to rise because companies are still having to pay more money, service industry people having to pay more money because wages are rising? We did see real average weekly earnings fall 3.6%, which is better than the 4% the prior month, but it still shows Americans are behind the inflation curve. They're losing money, and so there is still going to be wage pressure out there, and that's what the Fed's going to keep an eye on over the next 6 weeks or so.
Mike McKee, thank you so much, and happy birthday. Richard and James both still with us. Richard, just going back to that point of the services sector inflation, of some of the areas that are stickier and seeing increases, how much do we need to see that stabilize before you get confident in this move? What of the headline inflation number are you looking for?
So I think there's two things you want to look for. Number one is you want to see, as Michael just pointed out, the wage story. You want to see that actually really moderate pretty substantially. You know, some people have said we can't be in a wage and price spiral because wages aren't rising faster than prices. Okay, so we're in a price and wage spiral. Which came first, the chicken or the egg? And so if we find that prices are still rising and wages are trying to catch up, again, that negative real earnings that you were just talking about, people fighting back, trying to get their purchasing power back, the Fed is going to be very concerned about that and is going to have to stay on guard. I think that's really the most important thing. That you know, we're kind of having a mathematical recession, but this recession isn't going to be deep enough to loosen up the historically tight labor market. And as long as that's the case, you're going to still have inflation pressures.
James, do you also see a problem with potential wage price spirals, considering the fact that people are going to look for perhaps bigger incomes on the heels of a declining real income?
Lisa, I think the labor market is the story right now, and it is confusing, I think, for all market participants. You know, we do have participation rates not back to pre-COVID levels. The productivity data, as mentioned, are poor. Wages are going higher and higher. And I think we've unsettled the labor market to such we really don't know what it looks like going forward in a post-COVID era. So for now, the employees, the wage earners have the upper hand. We are seeing continued pressure on small business. We are seeing difficult to fill indices at all-time highs, and we're seeing wage growth high. And you combine that with some of the other metrics, you know, save the energy. This is still an inflation story. Yeah, better data at the margin is helpful, but we still have a price problem. We have an inflation problem, a regressive tax on all citizens. And the Federal Reserve, I think, is full on. I don't think this pivot or this notion of a pivot is going to bear out. And I think we stay at elevated Fed funds rate well into 2023 when I think we get the real recession.
James, just to push back, a lot of people would say you're so gloomy. Everyone on Wall Street is so gloomy, and yet you're seeing earnings that are hanging in there and actually expanding. You're seeing a jobs market that, yeah, it is going gangbusters, and that's a good thing. You're seeing an economy that's resilient. Why can you not be optimistic?
A couple things on that, and it's a fair point. Earnings were better, but what you see in earnings is you see price. You don't see units. And that's a big difference. You're not seeing a higher volume of goods going through. You're seeing the price level being accepted by markets. And that can exist for a time as long as the consumer balance sheet is healthy, which is turning at the margin worse. We're seeing savings rates drop. We're seeing credit expansion, credit balances increase. We're seeing charge-offs increase. So the point that I would make is if labor rolls over, which it may, if we have this demand destruction, we continue to see claims pick up, the consumer's not going to be quite as good a shape as I think markets believe.
Richard, what's your view?
So I think, Lisa, there's a couple of things. You mentioned earnings there. I think there's only two certainties that I would argue we have as we go through the remainder of this year into early next year. Number one is the Fed's likely to be tightening. Maybe today you could argue not as certain as maybe you were a month ago, but that's still pretty certain the Fed's going to be tightening. And number two, profits are going to be decelerating. I think that's the big story. Earnings growth in the S&P is still about 25% on a trailing four-quarter gap basis. We're actually predicting we're going to see a profits recession first half next year. I think the real weakness in the economy comes next year. I don't think we're there right now. And so I think to some extent there's a little bit of a head fake going on right now where people thinking that everything's calming down, everything's fine, we can go back and speculate in the markets. I'm not quite sure it's such an easy story as that.
Does today move the needle at all, Richard, for you? Do you change any of your allocations or your views based on the print we just got?
No, I don't think so. Look, Lisa, the Fed is still historically behind inflation. If you look at the real Fed funds rate, which throughout my entire 40-year career, everybody said that was the gauge that you used to tell if the Fed was tight or easy. The real Fed funds rate right now is about -6%. That is historically low. The only time it was lower, more negative, was in the last several months. But we're still in no man's land for negative real Fed funds rate. I find it very hard to argue that the Fed is actually an inflation fighter with a historically negative real Fed funds rate.
James, final word.
Well, it's not an uninvestable market, Lisa. As you know, the dividend story has played out beautifully for the year. The payers and the growers, the more defensive equity names have performed brilliantly versus the non-payers or the aspirational growth. And the bond market, from an income perspective, is as generous as it's been in a while, despite the rally in July. We have good corporate bond spreads. We have BBB type names, quality companies, free cash flow traded in 4.5% yields. And the muni bond market has caught a bid in July. So the bond market seems to have found its footing. And there are certain pockets of the equity market that are absolutely investable, particularly for income-oriented people.
Richard Bernstein, James Camp, both of you are sticking with us. Right now, we want to take a look at some of the stocks on the move, and they are very much on the move with the NASDAQ strong, more than 2% rally. Abigail Doolittle here with more. Abby.
Hey, Lisa. Well, yes, we do have stocks very much on the move. On that good news is good news CPI report. This, of course, means that yields have come in. That's helping out big tech, launching the markets higher. We have the likes of Apple up 1.5%. Banks rallying too, though, as the yield curves start to steepen a little bit. JP Morgan Chase up 1.4%. Tesla has the technology component, and it also has the fact that Elon Musk has sold $6.9 billion worth of Tesla in preparation for the possibility that he's forced to buy Twitter. And then finally, this is probably the most interesting one in a way, Lisa. Coinbase up 1.6% in the pre-market, down sharply. This, of course, after they disappointed with their user forecast and revenues. But Bitcoin is now higher on this better than expected CPI report. That seems to be helping Coinbase at this point. So this morning, truly a risk on.
Abby, thank you so much. Coming up, slower inflation providing the administration with some relief ahead of midterms.
This is the fastest decline in gas prices in over a decade. Nearly $1 drop in just 56 days.
That conversation is still ahead as we see the rally continuing on the heels of that weaker than expected CPI report. This is Bloomberg.
This is the fastest decline in gas prices in over a decade. Nearly $1 drop in just 56 days. U.S. oil production is up and on track to reach a record high. More work remains, but prices are coming down, and the president will continue to call on domestic and international oil producers to increase output.
Gas prices in America falling daily since their peak in June, 56 straight declines. Gasoline prices falling 7.7% in the latest CPI report for July. That is the most going back to 2020, April of that year. EIA is lowering its production forecast for the year, expecting a decline in gasoline demand. Breaking this all down for us, Bloomberg's Emily Wilkins down in D.C. and Julian Lee in London to really understand the dynamics here. Emily, how much can this administration claim credit to this versus the demand destruction that the EIA is reflecting as a result of just simply high prices curing high prices?
Look, the Biden administration is going to count this one as a win. They're going to message it as a win. But in reality, they still know that inflation is incredibly high for many Americans, that this doesn't suddenly mean that people are going to go to the grocery store and be like, oh, thank goodness, the prices are back down again. It's still going to be an issue they're going to have to deal with throughout basically the next several months and into the November election. So I think you're going to see the White House continue to highlight the bright spots in the economy, the jobs report, the lowering of gas prices, this month's CPI data. But they really know that overall they are still going to have to continue to message on what they want to do. And at least now they can say from a messaging standpoint that they do have these larger legislative package, like the bill with semiconductors, as well as the climate and tax bill that the House is set to pass on Friday. They can say, look, we are trying to do stuff to bring down costs. Here's the legislation that we've moved. And in that way, they can really try to explain that they are trying to do something, that they are taking action. They're not not just sitting in Washington, unable to move anything.
And Julian, how much can they claim this victory as we look into a season where prices could still go up pretty significantly? How much are people talking about a reversal in the declines versus a stickiness of this deceleration in price?
I think you've got two factors here that are very much working off against each other. One of them is the economy, forecasts of a slowdown, and the demand destruction that we are sort of starting to see, at least in some of the data. The other side is obviously the supply side. We've got EU sanctions on Russian oil exports that come into effect in December. So that could, if it doesn't take oil off the market, it's certainly going to make it necessary to transport it longer distances from Russia to markets in Asia. So that's going to add supply pressure. We've got OPEC Plus, who agreed an output increase for September of just 100,000 barrels a day. You can't really measure that kind of an increase in many countries. And I think that signals, firstly, that they are very worried about the amount of spare capacity that they have. And as that spare capacity shrinks, that puts more nervousness around production. And that would tend to push prices higher. And I think we're going to continue to see some quite volatile movements in crude oil prices, particularly over the next month or so when trading is relatively thin over the summer. So, a few traders moving one direction or the other can have a big impact on prices.
Julian Lee, Emily Wilkins, thank you both so much. And don't miss our interview with National Economic Council Director Brian Deese coming up here in just about 10 minutes. We are seeing oil fluctuate, WTI down about 0.3% after surging and then being down more than 1%. Richard Bernstein and James Camp back with us. Oil very much front and center when it comes to this story. As I said before, gasoline prices fell 7.7% in July after rising 11.2% the month earlier. Very hard to get your arms around. James, how are you positioning given some of the oil fluctuations and what you're expecting in terms of the sustainability of the declines we've seen?
Well, the key to positioning, Lisa, for us has been to be a little bit more aggressive in the bond market, because this sort of demand destruction or fall in energy, I think, is representative of a global slowdown. And so for us, it has been rotating out of risk assets, meaning stocks, underweight the equity side, an increase in allocation to the fixed side, which really occurred mid-June, kind of coincidentally. We think the secular peaks in the 10-year was. We look at the oil story more on a demand destruction global slowdown than it is some sort of policy win, if you will, in terms of getting more energy to more people. And the other part of the energy story for us, the food and energy story, really is consumers have been dealing with this for a long time. And when you go into a Fed tightening cycle with those two things elevated, energy and food stuff, you almost always, if the data that I'm looking at are correct, you fall into recession. And we think that's the story that's going to be dominating as we move into the back half of the year in early 2023.
That's fascinating, especially as you see food prices continuing to climb. In the CPI report, they increased almost 11% from a year ago, the most going back to 1979, not exactly a historical analog that you want to see. Richard, from your perspective, do you take the oil price decline, the gasoline price decline, as a signal, or is it noise? Is it reflective of people's belief in what will come, or is there true demand destruction and a true weakening in the economic outlook that you can then trade on?
So, Lisa, I think just broadening out a little to commodities overall, there's been a lot of people who have said that the worst in the commodity space is behind us. That's a very good sign for inflation going forward. I think it's a little early to, if I can harken back to the mission accomplished sign, I think it's a little early to put that banner up right now, given that China's been in a lockdown. Look, if China's economy is hitting on all 8 cylinders, or even 6 of 8 cylinders, and commodity prices are falling, I think we have something. But the fact that China's been in lockdown and commodity prices are falling, I don't see why that's insightful. I don't understand why that's a signal of anything other than China shut down. If you look at something like copper demand has started to go up. Copper imports into China have started to go up again. That may be a harbinger of things to come yet. So certainly, it's encouraging. It's encouraging politically. I understand that. But I think from an investing point of view, you want to be a little careful. So what we've been doing is kind of straddling, if you will, one foot in the late cycle sectors of energy and materials and industrials, and the other foot in the defensives, things like consumer staples and healthcare and utilities. I think what's very interesting is that most discussions focus on should you be in cyclicals or should you be in growth? Nobody talks about defensives, but in periods when profits decelerate, the Fed's tightening, that's the group that very often does quite well.
Richard Bernstein, James Camp, to both of you, thank you so much on this day of a CPI reprint that is very much changing market expectations right now. I'm very much looking at the dollar in particular, plunging, weakening, I should say, the most going back at one point to November 2020 as people assess how much the Fed could potentially back off from their rate hikes. Coming up, the morning calls and later the White House continuing its fight against inflation. We'll speak with the National Economic Council Director Brian Deese at the opening bell, plus a conversation with G Squared's Victoria Green. Right now, we are continuing to see that rally. 7 minutes to the opening bell. This is Bloomberg. We're about 5 minutes away from the opening bell. That strong rally fading just a touch, but still the Nasdaq up 2.2%, S&P up 1.7%. Bonds, really, you're seeing a bid into the front end. People moving away from some of the Fed rate hiking expectations, with two-year yields at 3.12%, down 14 basis points, and you can see that 10-year yield 2.7%. Dollar weakening across all currencies as people assess what it means for a Fed to move away. Let's take a look at some of the morning calls this morning. First up, KBW downgrading Coinbase to underperform $45 price target, citing elevated valuations and weak volume trends. Next up, Bank of America double downgrading the Real to underperform, expecting slower growth to weigh on its ability to gain leverage. And finally, Wedbush raising its price target on Twitter to $50 from $30. The analyst seeing a deal with Elon Musk in the cards. Coming up, inflation slowing down in America, still the very high rate, 8.5% year over year CPI. We'll get the view from the White House with National Economic Council Director Brian Deese. From New York, this is Bloomberg. This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Ferro. Moments away from the start of trading, you are seeing a strong rally on the heels of a weaker than expected CPI report. 2.4% gain for the Nasdaq, a 1.9% gain for the S&P. A bid into bonds, particularly the front end. People ratcheting back from some of the most extreme views of rate hikes coming up. You are seeing that come into the dollar with dollar strength across the board here as we ring the opening bell. The yield curve inversion getting less inverted as we take a look at the short-term yields declining faster than long-term yields. 10-year yields at 2.74%. And you can see crude off highs down about 0.5% as you talk about pipelines getting back online over between Slovakia, Ukraine, and Russia. Joining us now with a look at the stocks moving ahead of the opening bell. Here's Abigail Doolittle.
Well, Lisa, we are certainly looking at a bullish start here on that good news is good news CPI report. In fact, the S&P 500 right now headed to its best day in about 2 weeks. And if the gain holds, this will be the first time this year where we've had a gain on the day of the CPI print, really speaking again to the fact that coming in less than is good news for both the markets and inflation for real consumers. Microsoft, as a result, benefiting up 2.3%. This as yields come in, taking away valuation concerns. Chevron up just slightly, up about 0.3%. Oil at this point is down a little bit, but not weighing too much on Chevron because of the overall risk on mood. And then we, of course, have Bank of America and Visa higher as well on this report. And Lisa, most S&P 500 sectors are higher.
Thank you so much, Abigail. But definitely been a fascinating moment as we take a look at the rally. And let's take a look a little bit deeper as we see the Nasdaq leading the way. And this typically is the most sensitive area to interest rates. The more the interest rates come off, go down, typically big tech rallies. And you're certainly seeing that today, despite some of the weakening that we have seen, particularly in the semiconductor space. The Nasdaq up 2.4%, S&P 41.95, up 70 basis points. Really, though, the yield curve, we've been talking about it all morning. The inversion had gotten almost to 50 basis points. In other words, 2-year yields at the highest relative to 10-year yields going back to the year 2000. And steepening is really what we're seeing today. People going back from that, raising questions about how much the Fed can actually move away from that. You're seeing this in the dollar as well. Dollar weakening across the board. The euro now with a 103 handle. The DXY down a full percent, at one point down the most, going back, if you look at the BBDXY index, going back to the year 2020. How much can we start to see this add to the risk on element that we have here? Just to walk you through the data that we're looking at ahead of our interview here with Brian Deese, the chief member of the Chief Economic Council of President Biden. You did see an 8.5% headline print versus the 8.7% expectations. A significant portion of that was driven by energy. Food prices did increase. Shelter prices did increase. There was a lot of other spots that people are looking at, like services. However, a lot of the other areas have cooled off, which is the reason why people are getting a little bit more faith that the Fed could perhaps get a reprieve and not move as quickly as they previously had expected. For our audience worldwide on Bloomberg TV and radio, we're now joined by Brian Deese, White House Director of the National Economic Council. Brian, thank you so much for being with us. So you obviously have worked very hard to get oil prices down with the Strategic Petroleum Reserve release, and that was one of the big components bringing down some of the inflation here. How far are you willing to go? Is there more to do to bring gas prices down, or is this an area, is this a level that you're content with?
Well, look, this was a positive inflation report that we received this morning, 0% month-over-month growth on headline, and the core inflation, excluding energy and food, also moderated down to 0.3% month-over-month. One big driver, as you note, was the decline in gas prices that we've seen over the last 2 months, now down about $1 over its highs. And if you look at where the market is today in futures pricing, we would expect that to continue to come down. Energy markets, as you say, has been a key focus for us and will continue to be. And we would expect where the market is today to continue to see that moderation. But I think importantly, you saw in the July print moderation in other areas as well. Apparel down, airfares down. Automotive, used vehicles down slightly. So we're starting to see, at least in this report, some signs of deceleration in prices, even as there are price increases elsewhere in the economy. So we never over-index too hard on 1 month of data, but certainly this is a positive signal, and of course comes aside the report that we got last week on 528,000 jobs added in July as well.
Talking about jobs, real wages are still deeply negative. And even though they're less negative than they were in the prior month, still negative 3.6%, a historic figure. How much do you want to see the employee have pricing power at a time when so many people are worried about a wage spiral?
Well, we did see real wage growth month over month this month. I think you have to step back and answer that question in the broader perspective. We have seen one of the strongest labor market recoveries ever in American history, and we're seeing that labor market strength continue. That means that with jobs plentiful, people have opportunities to move into better paying jobs and better paying opportunities. That's a positive thing for the American economy. And what we're trying to do here is to take the steps that we need to take to bring prices down without giving up all of those labor market gains. That's absolutely our objective. And over the longer term, we think that we are well on our way to moving toward an economy that actually works better for typical working people, and where they do have more job opportunities and more leverage in the workplace. We think that's a positive thing, and we can get to that kind of sustainable wage growth, sustainable job growth through this transition. So we have to make the right policy choices, and obviously there are serious global uncertainties, but I think that the data points that we're seeing at least are hopeful data points that we're moving in that direction.
But Brian, even the Federal Reserve has cited wage growth as a possible negative when it comes to combating inflation. And we've seen this as especially Fed officials say that even they would like to see, not like to see, but that they need to see the unemployment rate increase and the labor market tighten significantly, taking away power from the employees. How do you deal with that, given that your view very much is trying to give people a living wage and bring up the individual employee?
Look, we're living through an unprecedented moment, and so there isn't an exact historic analog to the moment that we're in. So you have to go back more than 50 years to find a moment where the Fed began a tightening cycle when unemployment was as low as it is, and we've never had a situation with as many job openings in the economy during this cycle. So there are ways in which this transition can ease some of the labor market pressure in a way that doesn't have to mean that working people have to bear the brunt of that impact. And again, if you step back from a broader perspective, President Biden's view is that we had economic challenges that were putting working families in a negative position long before this pandemic happened, and that we are committed to building the foundations of an economy that will work better for working people going forward, even as we navigate through this transition. So that's why you see on the legislative front, even as we're working to provide some immediate cost relief for families, we're trying to do things like reform the way that prescription drugs are negotiated here in the United States. We haven't done that for decades. If we do that over time, that's going to provide sustained relief to families. That's the kind of longer-term reform we're working on, even as we address immediate challenges.
And Brian, you're referring, of course, to the act that was just passed by the Senate, now going to the House. How much are you prepared to spend more? Is the Biden administration prepared to spend more if there is, as the market broadly expects, a downturn in the next 12 months? How much is there the willingness to give some fiscal support, as people blame some of the fiscal support back last year for the inflationary surge that we're seeing now?
Yeah, I think that question misses the core economic challenge that we face right now, which is that what we need to do right now is we need to help bring prices down in a way that sustains the economic progress that we've made. We saw more than 500,000 jobs created last month, while the inflation print was zero. We can keep making progress on that front, and the way to do that from a fiscal policy standpoint is exactly what the Inflation Reduction Act does. Bring down costs for prescription drugs, for healthcare, for energy, while reducing the deficit. This is a bill that will actually contribute to additional deficit reduction, which is complementary to what the Fed is trying to do, and help us move through this transition in a way where we don't have to give up all of those economic gains. That's the right economic prescription right now. It's why we're working so hard to get it done and in place. And if we do that, we're going to be better positioned to navigate through this transition and get to that period of steady, stable growth than any other country in the world.
Brian, has this administration done everything that it can to bring down inflation?
Look, I think you see a president and you see administration right now that is using all the tools at its disposal and also working on the most important things. And that's why we really are focused on the Inflation Reduction Act at this point, because there is no more significant step that Congress or the president could take than passing this piece of legislation. It will have historic impacts, bring down prescription drug prices, bring down healthcare prices this fall for millions of Americans, and have a long-term sustainable energy strategy that will reduce prices for people and their utility bills. That's the most significant step that we could take, which is why you're seeing the priority put there, even as we are working on supply chains and ports and logistics, as you mentioned, the Strategic Petroleum Reserve and elsewhere. We're using all the tools at our disposal, but we're also prioritizing those that will be the biggest dial movers.
Brian, I'm sure that you saw this University of Pennsylvania, the Wharton School study that showed that not only would this Inflation Reduction Act not necessarily reduce inflation in the very short run, but it might increase it before bringing it down in 2025 and beyond. How much do you give evidence or rebut that? And if that is the case, how much are you leaning on gasoline prices to really take the lead here as that, as you expect, continues to decline?
So I think, that study said that the impact would be negligible. Respectfully, we have looked at the broad consensus of economists, including those who have not necessarily agreed with us over the last couple of years. Former Treasury secretaries from both political parties have all said this bill will help reduce inflation while also lowering costs for families. We think that that's exactly the economic prescription that we need, and we think that that's the impact that this bill will have. Obviously, gas prices and energy prices are incredibly salient for American consumers, and they hit people in their pocketbooks. So when we bring the price of gas down by $1 and we keep having some progress in bringing that down, that's a positive thing. But I think, as you saw in the July print, what we want to see is more progress in that direction, where we're seeing prices moderate across the board. And that's what we saw in this July print. It was, of course, gas prices were doing a lot of work here, but we also saw absolute declines, as I said, in things like airfares and apparel consumer electronics. And so we want to encourage this transition to where price pressures moderate across the economy, but also do things that will make things more affordable for people right now. Because at the end of the day, typical families look at their monthly budget all in. So if we can provide some relief on things like prescription drugs or healthcare premiums, that's going to help them overall.
Brian Deese, thank you so much for being with us. Brian Deese, White House Director of the National Economic Council. We appreciate you taking the time. Right now, we want to take a look at what we have been seeing, which is a market rally on the heels of a weaker than expected CPI print. Good news is good news, I guess, for markets as people expect the Fed to possibly walk back some of the most extreme versions of rate hikes. Victoria Green of G Squared now joining us. Victoria, what was your first reaction to this report? How much is this something that you can materially trade on versus one data point to plug into a series?
It's one data point, and we're going to look for a trend. You know, what does August bring? And August may bring the same type of relief, at least not growth in inflation, because we've seen continued moderation of oil prices and energy prices and gasoline prices here in August so far. I think it's something that it's good, it's dovish, but it's not bullish necessarily. It just means congratulations, we had record high inflation, we just didn't add to it here in July. So you kind of have to step back and look at the data and think the Fed is still going to hike in September. Now, the probability of 75 basis points went from like 77% to 44% after this print. So it looks like it's going to be 50, 25, 25, which is a more moderated pace. Now, we have another data point set here in August, so we'll have to see how this month plays out. And obviously, energy prices and commodity prices is something that we're watching very, very closely, because that seemed to be the leading indicator. So if oil continues to come down, which it has slightly here in August, if gasoline prices continue to come down, we could see that add and help keep CPI stable. The question on everybody's mind is, are we plateaued at this 8% plus, or are we going to see this eventually start to decline and move back down? Now, I was charting, it was very interesting. This morning, I was charting the speed and rate of change of CPI here in 2021 and 22 versus the 1972, 73, and we have gone up much faster than if you look at the chart of CPI in the 70s. And so the question is, will we see a fast reversal, or are we going to end up plateaued and it's going to be sticky? Sticky inflation is hard to beat.
Victoria Green, you're going to be sticking with us, and we're going to dive more into that. But coming up, President Biden pushing for more domestic semiconductor production.
Unfortunately, we produce 0% of these advanced chips now, and China is trying to move away ahead of us and manufacture these sophisticated chips as well.
That conversation still ahead, and the chip sector has gotten hammered in the equity market. A bit of a reprieve today as we see a wide-ranging rally on the heels of that CPI report. This is Bloomberg.
Unfortunately, we produce 0% of these advanced chips now, and China is trying to move away ahead of us and manufacture these sophisticated chips as well. It's no wonder the Chinese Communist Party actively lobbied U.S. business against this bill. The United States must lead the world in the production of these advanced chips. This law will do exactly that.
President Biden citing the CHIPS Act into law and unleashing $52 billion for U.S. semiconductor production. Micron Chief Executive Officer Sanjay Mehrotra weighing in on the legislation yesterday. Take a listen.
It will enable us to meet the growing demand for memory that is anticipated for this decade. Memory is expected to grow faster than the rest of the semiconductor industry, and memory consumption is expected to double by the end of this decade. And we will need more wafer capacity in order to supply that demand.
For more, Bloomberg's Ed Ludlow joining us now from San Francisco. Ed, it's been a bloodbath in the semiconductor space. Do we have a sense of how significantly this CHIPS legislation could affect that and what's behind the declines?
Yeah, I mean, the impacts will be delayed and it will be limited in the near term. Philadelphia Semiconductor Index up 1.8% today, but remember yesterday it dropped by the most in 2 months. And what's really changed is in this earnings period, the breadth of worry. We started with Intel and Nvidia giving us an indication that demand for PC had dropped, the chips that go into PC. Now that's expanded through Micron to DRAM memory chips and a broader sense that demand for consumer electronics through to data centers is falling off, and that in turn is also stoking recession fears. The $52 billion number from the White House appears to be a big number, but the reality is that to build infrastructure and capacity for manufacturing of semiconductors takes many, many years. The $52 to $53 billion figure is also nothing compared to the capex plans of a number of Asia-based chip manufacturers who are moving simply much more quickly. And as you look across Wall Street, there's muted enthusiasm on the impact that this will have, other than to sort of give a shot in the arm of the domestic industry to onshore this demand. We've really changed our focus in recent weeks. We went from talking about a multi-year continuation of the expansion of demand for chips to going back to being with concerns about a supply glut. Remember, this is a boom and bust industry historically, and now that signs our demand is curtailing off, we've already seen additional investments to expand capacity. The worry is that we get left with a chip glut.
Ed Ludlow, thank you so much. Still with us, G Squared's Victoria Green. She's been staying defensive amid rising rates, writing, a quote, value is still a good place to be, and this is more a bear market reversal rally than June being the true bottom, especially with tech seeing some pressures and semiconductors struggling with potential gaming and PC slowing down. Victoria back with us. Victoria, how much do you double down on this conviction despite the rally, despite some of the reprieve in inflation that we just saw in the CPI print?
So I look at the fundamentals and what has really been this rally. What has this rally been based on since the June lows? And it was a sentiment-based rally, maybe a technical-based rally, but it certainly really wasn't on earnings and company fundamentals. And so I look at this and I say, what does the CPI print mean for earnings going forward? Does it move me off the sidelines? And I say, one, no, we're still in a tightening cycle. Two, yes, the U.S. dollar may moderate some, but we're still seeing a very strong U.S. dollar, which multiple countries warned on for revenue drag. And then three, we have a lot of time between now and September. You know, how bullish, bearish are the Fed going to be, and what's going to happen with unemployment? So we look around and we still feel like it's a contracting world. And this is a very confusing market. You have some data points saying we're strong market, but, you know, you have a tight labor market, you have low unemployment, you have a stock market that's coming off its lows, and the stock market's a leading indicator. So maybe everything we're looking at is backwards data and we're late and behind. But if I look at fundamentals, I still see a lot of headwinds that I'm just not comfortable chasing risk yet. I get it. The meme stocks, the ARK funds, the techs, that's been the major rally point coming off the lows. But if you look under the hood at the numbers, the number of companies that are warning, the number of companies that didn't make as much money, the number of downgrades and earning revisions that we've seen, and the expectation on the second half, I'm just a little reluctant to chase into this. I own stocks still. We absolutely still have an allocation. So we're going to ride this wave a little bit. I'm just not throwing all in. I'm not going to go all in when I don't have anything supporting this on the fundamental side.
Just quickly, Victoria, what are you looking for to change your view? What data point, what development?
I think if we actually saw a healthy economic growth, a healthy consumer, you know, we're still seeing pressures on the consumer. Food prices, home prices still going up. I see this as a potential temporary. So yes, I'd like to see company fundamentals, their ability to grow earnings, their outlook for earnings be a little bit more cheerful. And I honestly am concerned about global growth. You know, what's going to happen in Europe with gasoline? If Europe sneezes and gets a recession, can we stay out of it? Are we in a recession? I think there's too many data points that aren't bullish right now to chase into it.
Victoria Green, thank you so much for taking the time. Coming up, we have the market-moving events that you need to be coming and watching in the week ahead. That's next in our trading diary. In the markets, you can see that sustained rally on the heels of the inflation rate. From New York, this is Bloomberg. The rally is fading just a touch as we get longer in the session. The Nasdaq up 2.1%. S&P 4191 up off of the 70 basis point increase, 1.7%. Yields are lower, particularly on the front end, 3.115%. Here's time for the trading diary. What you need to be watching this week. President Biden speaking at the top of the hour, followed by Fed speak coming from Evans and Kashkari. We'll get U.S. PPI and another round of initial jobless claims on Thursday, and finally rounding out the week with the University of Michigan sentiment survey on Friday. This was Countdown to the Open. This is Bloomberg.